Let's see how the markets are moving. Asian stocks fell today as investors remain concerned after the collapse of US-Iran peace talks and renewed fears of a blockade in the Strait of Hormuz. Regional markets declined as oil prices rose, reversing gains from the previous week's ceasefire optimism. Japan's Nikkei lost 0.8%, Hong Kong's Hang Seng dropped 0.9%, and China's Shanghai index ended flat. Over in the United States, stocks closed mixed on Friday, with investors pressing pause as they headed into the weekend and kept an eye on the ongoing Middle East peace negotiations. A closely watched inflation report showed consumer price growth accelerated as expected due to price pressures arising from the war in Iran. The S&P 500 lost 0.10%, the Nasdaq Composite gained 0.35%, and the Dow Jones Industrial Average fell 0.59%. Now, local markets starting the week in negative territory after US-Iran peace talks collapsed in Islamabad over the weekend. US President Donald Trump announced that the US Navy would move to blockade the Strait of Hormuz. On the JSE, the all-share index falling 0.7% to 118,110. The rand at 16.53 to the dollar, 22.19 against the pound, and 19.32 to the euro. Gold trading at $4,716 an ounce, with platinum at $2,036 an ounce, and Brent crude oil at $102.30 per barrel. Right, let's bring you some insight on the markets. I'm joined by Makwe Masilela, who's Chief Investment Officer of Makwe Fund Managers. A very good afternoon to you, Makwe. Thank you so much for your time. As we watch and perhaps speak on the back of the broken talks in Islamabad, we're seeing oil up. It's jumped above the $100 mark a barrel after the US threatened a Hormuz blockade. Stocks are down, bonds falling, and the dollar strengthening. What does this tell us about investor sentiment right now?
You know, investor sentiments unfortunately got to be dented. And as we see that the risk, people are moving away from what we call risky assets. And then unfortunately, the likes of the US dollar gets to be preferred as a safe haven asset. But just to put it into perspective, here is that this ongoing conflict, what it all does is that it gives us like a dual challenge, that is high inflation and then also slow growth. And as we know that with high inflation, all these other things that's falling apart. Hence, we have the likes of, what do you call it, gold itself not doing that great, because people think that interest rates will stay higher for longer because of high inflation. Hence, we expect that the economies all grow, because high inflation, we know itself, it's a monster. It gets to dent almost everything, and high interest rates themselves makes life difficult for everyone, whether it's companies when it comes to repaying debts or individuals when it comes to repaying their own debts. But the market reaction today, I think, given the performance that we've seen last week, because the whole of last week, the JSE was up almost 3.5%, and Friday ended up almost 0.9% up. I think we're cautiously resilient so far.
Cautiously resilient. The Strait of Hormuz carries a large share of global oil supply. Are markets reacting to real disruption risk, or is it mostly geopolitical fear? How do you read between the lines?
You know, markets say, listen, we're optimistic, or that there's a chance that guys can still talk. We might not get a near-term solution, but medium to long term, there will be a solution. And I think at the back of that, markets think that things will be sorted out. As an example, we know that most of the oil coming from Iran goes to China, and people think that, hey, the US don't want to start fight with China. And as we're talking, we know Donald Trump yesterday indicated that he will impose almost a 50% tariff when it comes to China, because China apparently is indicating that it will be loading some weapons to Iran, and Donald Trump said anyone who does that, they will get 50% tariffs. But also the inflation number that we spoke about, in our intro on Friday itself, it tells us that globally our central banks have to deal with inflation, because we all know that the war started at the beginning of March. So now March inflation will show that it is shooting up for all the governments or economies. So that's another thing that people have to deal with. And high inflation itself, unfortunately, it tends to eat on our earnings expectations or forecast.
Makwe, as you talk about central banks, higher oil prices typically feed directly into inflation. How worried should central banks be at this stage?
Very worried. Remember, before we used to have enough room when it comes to the physical movements, that governments will intervene and try to help the situation. Unfortunately, now if you check, the debt to GDP ratio is very high, meaning most governments don't have that headroom to be able to maneuver. So this is a serious challenge for them to see how will they be able to deal with that. And as it stands, we know we started the year expecting interest rate cuts. So now central banks are very cautious and they don't want to frighten us by starting mentioning that they might have to start looking into increasing interest rates. Probably they don't move, they just keep in where they are for a longer period of time at this elevated level.
So with that, we know that South Africa imports most of its fuel. How quickly could South Africans feel this oil price surge at the petrol pump, as we were looking to some sort of hope, I suppose, with those talks that were underway in Islamabad?
We just had a petrol price and diesel price increase. And now when we had that, at least the guys will be talking. That's after the guy announced that 2 weeks ceasefire. Then we saw oil prices dipping below 100. But now with what happened over the weekend, oil prices are now back above 100. And at the same time, you're getting the rent itself weakening. So that itself exacerbated the situation. So what we thought we'll get as a relief, because we saw diesel, crude prices dipping below 100, unfortunately, in a way, we might get another petrol price or diesel price increase.
As you talk about that frightening word, hike, petrol, diesel, what should ordinary South Africans watch most closely in the coming weeks to understand exactly how serious this becomes? I mean, it's serious for one when you talk about diesel, fuel, and the ripple effect, of course, is on transport, food, and so forth.
What we need to continue to watch is the developments of the highlights when it comes to oil and the reaction when it comes to global crude prices and unfortunately our rent itself. But most of the things, unfortunately, our government doesn't have control over. As we've seen, they've tried to give us a little bit of relief. They don't have control because the rent itself is a floating exchange rate. They cannot control that. Oil prices themselves, they don't have much to do. All they can do is to continue or quickly, as they told us that they are looking into the pricing of the petrol itself, that they have to quickly work on that and maybe have to get a solution which has to be a long-term kind of a solution. And we have seen most governments as well, they're trying to help their people by trying to give some relief. But that relief can only be for a period of time because your fiscus doesn't have the right balance sheet to be able to absorb that for a longer period of time. So you need more of a sustainable solution, which is to re-look into the pricing when it comes to petrol and diesel prices.
Very well. Thank you so much for speaking to us this afternoon. Makwe Masilela, Chief Investment Officer of Makwe Fund Managers, just speaking there to the level of cautious optimism that needs to be exercised at this point as a sustainable solution is sought. Of course, the impact, seeing oil prices jump above the $100 per barrel mark,